Hey everybody, welcome back to Drawbridge Finance. Today I'm going to be continuing my series of beginner option trading. Hey there everybody, welcome back. As always, my name is Levi Woods. I'm not a financial advisor. I don't work in the finance industry, and this is an opinion channel about money. Now, for those of you who have been following me for a while, you know that my primary investment vehicle is dividend investing. And I have to say, I've been doing it a long time. I've been dividend investing since 2003, and it is an extremely boring process. I make money off of it every single month, and I don't really have to pay that much attention to most of my dividend investing. And for that reason, I was looking for something to do that was more engaged, to allow me to be a more active trader. As my account grew, I was able to look at different types of trading strategies. And one of the things I discovered back in 2014 was option trading, and I have absolutely fallen in love with it. Now today, I'm going to be putting on a position that is similar to an Iron Condor. So what it is it's a selling premium strategy, but it has defined risk. And now I'm going to skew mine a little bit so it has more risk to the downside than the upside. So I'm going to go over this trade in detail. Now, if you guys are interested in the written version, you should check out my Patreon account because I actually posted this morning when I made this trade. Now, even if you don't choose to follow along with my trades every single month, that is totally fine. I mean, the option trading especially is fairly advanced and requires a fairly large amount of capital to follow along and make money with options. But if you're interested in just seeing the type of postings that I'm making, I do lots of free posts. So follow me on Patreon, check that out because the free posts are worth it. I mean, free is great. And that's what this is about, is like providing information so that we can all get rich together. That is my goal. So today I'm going to delve right into this and let's take a look. For those of you that are new at options, this is an options chain. So what we're looking at is SPY, which is the S&P 500 ETF. Now we can see the current price is $295.43 and it's down $1.57 today, or 0.53%. Now this is Interactive Brokers. I don't know what platform you guys are using, but these are all fairly similar. So Thinkorswim or Tastyworks or Interactive Brokers. But the mechanics of it are fairly similar. So once you have a platform that can allow you to look at this information, it's good to kind of understand what we're actually looking at. So the first thing we do is we look at this tab up here, and this is showing September 27th, which is today. So these are option contracts that would be expiring today. Now, obviously, I'm not going to trade anything that's expiring today. I'm an option seller, and I want to collect time decay premium. Now, to do that, I have to enter a position that has some time left in it. So I'm going to put this on as a very, very short trade. I normally trade on like a 45-day window, but on this particular day, I'm going to put on a 21-day trade. And the reason for that is because it's relatively easy to estimate what the target value is of the stock or ETF. And after 3 weeks, the trade closes and we don't actually have to do anything other than today unless the stock moves out of our target. Now it'll make a little bit more sense when we take a look at this. So I'm going to go to more here, and you can see that we can trade options well into the future. I could trade options up into 2022 if I wanted. What I'm going to look at is October 18th, which is regular. So on this one, the yellow ones are weekly contracts and the white ones are monthly. So we would have November 15th would be the next monthly and December 20th would be the next monthly. And that's where I like to trade, is I try to trade in the monthlies as much as possible. So I'm going to click on October 18th and it's going to pull up this tab, and then it's going to populate this options chain. So we know there's 21 days to expiration. And what we're going to do is we're going to look at the strikes and we're going to build a strategy. So down here at the bottom, there's a strategy builder and Interactive Brokers. And this is just a test account. I don't actually trade on this. I literally just use this account to set up these trades, and then I trade in my real account. But Interactive Brokers has a really great layout and allows me to put in these trades and see a lot of data. So that's why I'm showing it to you guys today. So the trade that I put in this morning, now I put this in about an hour ago, and the stock has actually gone down quite a bit since then. So the trade that I put in was the 287 put. So I'm going to click on sell here. So the strike price is 287. Now remember, we're trading at 295 right now. So this is, here you can see 295. That would be the at the money position. So we are $8 out of the money, and that's the put. So I'm going to put that position on. Now, on the other side, we want to do similar. We want to go, it's trading at 295. I'm a little bit bullish on the SPY in general right now. So I'm going to look at the 305, the call. So you can see right here, we'll just go through all the columns. Open interest. So 112,000 of these are open. And the volume today is 3.25. So over 3,000 of these contracts have already traded today. The bid size is quite large, 482. We don't have to worry about that. I'm just going to do a demo. So I'm going to just show you one contract. So the ask size, 6,000. Don't worry about that. Delta is important on this. So that's one of the things that I look at all the time. And then theta is also important. So those two things are going to look at. And currently, we've got the bid, which is the amount of money that somebody's willing to purchase these for right now. And the ask is the amount of money that somebody would be willing to sell with this option for. Now, I want to sell it. So I'm a premium seller. So I'm going to click on sell. And this is automatically going to add it down here. So we can see what this is setting up as a short strangle. If I wanted to sell with no protection, this would be the position that I could put in. So October 18th, 287, 305 short strangle. What that would mean is if the stock, which is currently 294.82, if it stayed above 287 and it stayed below 305, so if it stayed in that range, I would collect a certain amount of money today, and we can see that right here. It would be somewhere between $2.74 and $2.71. If it stayed in this range, if it stayed above 287 and 305, then I would get to keep all of that money. Let's just take a look at a chart right now. I'm going to pull up a 1 hour chart here. These are hourly calendars. So this is going back to August 23rd. It's pretty easy to see that 287 is down here. So this would be the bottom part of the range, and then the top part would be 305. So if the stock, which is currently here, in the future trades up, as long as it doesn't breach 305 or doesn't breach 287, then I would collect the maximum profit on this particular trade. That maximum profit would be $2.69 times the number of shares. And for each option contract, it controls 100 shares. So $2.69 times 100 will give us $269 profit minus commissions. But I don't want to sell a naked strategy. And the reason for that is I'm just going to click on the profile and open this up for you. It takes a second to load. So this is what the chart looks like. And what this shows is that the probability of profit is 71%. That's amazing. That's kind of what we're going for. And I'll show you a little bit of how I selected these particular strikes to get that after I set up the trade. But the max loss is unlimited. And that's where it's scary, especially for new investors, because if the stock decides to really tank in the next 3 weeks, if that stock drops to $250, say if we just go on this chart, we would have a loss of minus $3,000. And now that just doesn't make a lot of sense. Like, why would we risk losing an infinite amount of money to get a maximum return of only $250? That doesn't make a lot of sense. So what I want to do is I want to add in some protective positions and change this so that if the stock goes really, really far, there's a maximum amount of money that I want to lose. And what I'm going to do is I'm going to add those in now. I'm going to scroll down here a little. So we're talking about selling the call at 305. Now, if I put in a $5 wide strategy, then I'm going to buy this for only 9 cents. I'm collecting 42 cents for the sold position. So effectively, the most amount of money that I can lose is the difference between these minus the credit originally collected. So if the trade went totally south and the stock went way up and it went way above $310 for some reason, it was a massive rally, the most I could lose is $500. 310 minus 305 times 100 is 500. And I'm going to do the exact same thing on the bottom side, but I'm going to be a little bit more aggressive on the bottom side. I put in the position at 279. So I'm going to buy the leg at 279. Now, the reason I did this is because there's quite a lot of value in here. I'm trying to get as much premium as possible when I put on these trades. And this trade right now, because the stock's gone down, is actually quite a bit more than I sold it for. So now that the full entry has been put in, we can see what we're doing. We're selling the 287 put, we're selling the 305 call, and that's the primary position. And then the protective position is the buying of the call at 310 and buying the put at 279. This puts it at a delta of 0.03, which is nearly neutral. Now, this is a non-directional strategy, so I don't care if the stock goes up or down. So when I put it on, and that's the only time I can actually choose this, because once I put on the trade, I'm at the mercy of the market, where we'll see where it goes. But when I enter the trade, what is this delta value? And I want, for this type of strategy on the SPY, I don't know. I can't foresee the future. I don't know if it's going to go up or go down. So I want to be delta neutral. I want to be as close as possible to zero delta. The other important thing is the theta. Now, these are all negative, which means as time goes past, each of these option values are going to be decreasing by a certain amount of value. So at expiration, if we work it all out, we're getting about 4.5 cents per day per contract over the next 21 days, and that will be the time decay value. So this positive theta is great. The total bid ask right now is between $1.44 and $1.38. So, and these are pretty liquid markets, so I would expect to fill somewhere around the mid price of that. So maybe like $1.41 would be the price that I would expect, or $141. Now, I actually sold this position for $119 or $1.19 earlier today. Now, how did I choose these? Now, again, the market has moved quite a lot since I put on this trade. It was trading at 297 and we're trading at 295 now. So it's a $2 move already. And that's where you can see this colored chart of how much the expected move is. On Interactive Brokers, it actually shows dark blue is the single standard deviation move. And what we're looking at is the delta value to determine this. So this call has a 10.7% chance of being in the money or above $305. It only has a 2.5% chance of being above $310. We can just read that right off of the delta. And then likewise on the put side, if we read the delta, it has a 25.7% chance of being below 287, and it has a 13% chance of being below 279. Now, if I was putting in this trade right now, seeing that the market has moved, I might adjust these a little bit. I might move these strikes up to a lower delta value. I typically aim anywhere between like 16 and 22%. So if I was being fairly aggressive, which I usually am when I'm putting on especially a defined risk trade, which this is, I would be in that low 20s, kind of 22 mark. So I would be probably selling the 285 if I was putting this on, and then I would just move this up. So let's just take a look at that. If I was putting on the trade right now, I would probably be looking something like this, widening out those strikes a little bit, keeping the 279 or 13%, bringing this down to 22%. We'd tighten it up a little bit, would mean we're collecting a little less premium, only $1.07, but the delta would be right near zero, which would be ideal place, and still theta decay of 4 cents. I'm going to put this back to the trade that I actually put on because that's what we're looking at today. Put that on, so $1.38, and I'm going to click on this profile button, and we're just going to take a look at this so that we can see the chart and see how it's slightly different. So now this chart is more in line with a beginner trade. This shows right here that if the stock stays between 287 and $305, then we make the maximum profit, which is $133. If it goes way above, it doesn't matter how far up it goes, the maximum we can lose is $366. Now the reason that math works is we have a $5 wide spread on the top. So because the calls are 305 and 310, the maximum we can lose is $500. We subtract the amount of credit received at the beginning, and then we get our theoretical, or we get our calculated max loss. So the max loss on the upside is $366, 500 minus the 134 that we would collect if we sold right now. Now on the downside, because the protective put is a little bit wider, it's $8 difference, 279 of the bought put, and 287 of the sold put. We have an $8 difference, which means $800 is the maximum we could lose. $800 minus the 134 that we would collect, and that gives us a maximum loss of 667 or 666. That's how that's calculated. So this is a great ratio right here. We get to see the risk return, 1.21. The chance of profitability is 66%. That's right in line where I want to trade. Most of the time, I'm going to be in the profitability range, 66% of the time. Maximum return, $139 if I was putting this on right now. And the maximum loss would be $661. It also tells me on here that I have a 6.1% chance of hitting that max loss. And that's really where it is. Like, the likelihood is that I'm going to be close to this max return, or slightly less than that max return, or a very slight loss. The chance of getting to this maximum loss are only 6%. And that's why these strategies work so well over time. If we put on enough instances of these strategies, we hit that max profit most of the time, 66% of the time. And the other 33% of the time, when we don't hit the maximum profit, we're not hitting the maximum loss. We're actually just at a minimal loss. It's in between either making 138 or losing 662. Well, I know that this has been a ton of information today, and you guys are probably just completely overloaded. If you have any questions about this, please feel free to ask them below. Leave a comment. Tell me if you liked this video. Tell me if it was like way over your head. Because once you get into these strategies, you start to realize that we do the same thing over and over and over again. We're selling premium, we're selling a put, we're selling a call, we're putting on a protective put, we're putting on a protective call, and that's it. That's the whole strategy. We just do that again month after month, and we can make quite a substantial amount of money for this. Now, I should also note that in this particular account, it says my margin impact is $344 Canadian. In actual fact, it was like $3,600 for me to put on this trade. So I have to have $3,600 in capital or in cash in my account to put on this trade to make the $137. But we do that month after month, and then we just continue to grow our account over time. Anyways, I hope you guys enjoyed today's video. Thanks so much for watching, and let's get rich together.